If you're a homeowner in Colorado right now, you know exactly what we're talking about. You open that renewal notice, and it's not just an increase, it's an interrogation.
Mm-hmm.
Your neighbor got non-renewed, maybe you just got hit with a 50% rate hike, or, maybe you're closing on a house and the quote you got just blew up your entire debt-to-income ratio.
Yeah.
It feels personal, it feels arbitrary, and honestly, it feels like the system is just collapsing around us.
It feels that way because, quite frankly, it is. We are not experiencing some normal market fluctuation here. Colorado is officially in what we classify as a severe insurance crisis zone for 2025 and 2026.
Wow.
The financial reality is just hitting us all very, very hard.
So give us the big picture numbers then, because that's the first thing that spikes everyone's blood pressure.
The rates are staggering, and they just keep climbing. We are projecting the average annual premium for Colorado homeowners insurance to climb to around $6,630 by the end of 2025.
6,600.
That puts Colorado among the 4 most expensive states in the entire country for home insurance. And to grasp the speed of the change, rates have gone up a breathtaking 233% since 2007.
Wait, 133%. That's not inflation. That's something else entirely.
Yeah.
What is the core mechanism forcing this kind of, violence in the market?
It really just comes down to unsustainable losses, and that's all driven by catastrophic weather. Think about 2023 alone. Colorado property owners paid roughly $4.58 billion in premiums across the state.
Okay.
But insurers faced $4.81 billion in claim payout.
Hold on. They paid out more than they took in.
Exactly. That is a 115% loss ratio. For every single dollar a carrier collected in premium, they were losing 15 cents.
Wow.
And that's before they even paid their employees or their utilities or any operating overhead. It's financially suicidal.
Well, that makes perfect sense why they're retreating then. If you're consistently losing money, you stop playing the game.
Precisely. And this unsustainability is causing 2 major consequences that affect you, the homeowner, directly. First, the global reinsurers, who are basically the insurance company's insurance.
Right.
They're charging primary carriers drastically more for the privilege of operating here. That cost gets passed directly down to you.
Of course.
Second, and much more dangerously, the primary carriers are just pulling back. We're seeing insurance deserts forming in certain zip codes, especially along the Front Range.
So like whole areas where you just can't get coverage.
You can't get a new policy. Major national carriers, the big names you trust, are restricting or just refusing to write new business because they've hit their catastrophe limit for this state.
So we've established the pricing is painful, the options are shrinking. But our mission here today isn't just to talk about cost, is it?
No, correct. The objective of this deep dive is to pivot away from your frustration about the price to a place of urgency about your liability. The real danger isn't the high premium. It's that you might be paying that high premium for a policy that has massive hidden gaps in coverage.
So you're paying more for less.
Potentially, yes. If you are a Colorado homeowner who hasn't actively reviewed your policy in the last 2 years, the old rules do not apply. You might be catastrophically exposed. And to understand why carriers are panicking, you need to acknowledge Colorado's unique threat profile. We are not a one disaster state, we're a dual catastrophe state. We're battling 2 major financial threats at the same time: wildfire and hail.
Right. Wildfire gets all the headlines, especially after the Marshall Fire, but I keep hearing that hail is actually the dominant financial driver here.
It is the dominance factor, yes. Hail damage is the single biggest driver of cost statewide. State figures show that 60 to 70% of the average premium paid across Colorado is dedicated solely to paying for hail risk.
60 to 70%.
Yeah.
Just for hail.
Just for hail. We sit right in Hail Alley along the Front Range. And when you look at events like the May 2024 Yuma storm, residents saw baseball-sized hail. You realize the severity and frequency the carriers are pricing for are just increasing exponentially.
And then the wildfire threat is the one that destroys entire communities in a matter of hours.
Absolutely. Almost half of our population lives in what's called the wildland-urban interface, where developed areas butt up against open spaces.
The WUI.
The WUI, exactly. And the Marshall Fire, which destroyed over 1,000 suburban homes in Boulder County, that was the defining moment. It proved that vulnerability isn't limited to remote mountain cabins. The threat is very real for suburbs right off major highways.
Okay, so let me be the voice of the frustrated homeowner here for a second. My rate just went up 40%. I'm stressed. I see an ad online, promising I can save $200 right now by getting a quote directly from a huge nationally known captive carrier.
Right.
Why shouldn't I take the path of least resistance and just try to save that money?
Hmm.
They seem reliable, right?
That is the most common temptation, and this is where we need to execute that crucial objection handling. Yes, you have to acknowledge the 40% rate hike. That's just the cost of admission to this market right now.
Mhm.
But the real danger is not the high rate. The real danger is that in chasing that $200 immediate saving, you might be buying a policy that still has a 2% percentage wind deductible or an actual cash value clause on the roof.
Wait, I thought my deductible was $1,000. Why would they change that without telling me?
Well, they don't exactly advertise it prominently, but if you take that cheap quote online and sign up, you might have just swapped a $1,000 deductible for a potential $10,000 bill waiting for you after the next storm.
Wow.
You are trading a small, immediate premium savings for a massive, hidden financial exposure. And that's why DIY insurance shopping in the current Colorado market is just reckless.
And here's where it gets really interesting, because the nightmare scenario you just outlined, that massive hidden financial shortfall, that's exactly what played out on a mass scale after the Marshall Fire.
It was a systemic, heartbreaking underinsurance disaster. When we analyzed the data from Marshall Fire victims, the results were just shocking. The overwhelming majority were underinsured. 74% of policyholders fell short of their rebuilding costs,
74%.
and more than a third, 36%, were classified as severely underinsured, meaning their policy covered less than 75% of the total reconstruction cost.
74%. So you're saying 3 out of every 4 people who lost their homes thought they were financially protected, but they were wrong. How do so many financially savvy people make that same exact mistake?
It comes down to confusing two very, very different numbers. Homeowners mistakenly insure based on the property's market value, what they could sell the house for, which includes the land and location, or they insure based on their mortgage balance.
Right.
Neither of those numbers has anything to do with the true reconstruction cost.
Okay, so explain that difference then. Market value versus reconstruction cost in, practical terms.
Okay, your market value might be $800,000. But if your house burns down, you don't need insurance to pay for the dirt. You already own that. You need insurance to pay for the specialized inflated cost of labor, materials, permits, architect fees, and debris removal required to build a new home from the foundation up on that existing plot. That number is almost always significantly higher than your market value, especially in a supply-constrained environment like the one we had after Marshall.
You mentioned the story of Manu Sapti. He thought he was fine, and then?
Manu Sapti, who was in Superior, he found out the hard way. Despite believing his insurance was robust before the fire, after the total loss, he ended up spending $1 million more than his insurance paid out just to rebuild and replace the contents.
$1 million out of pocket.
His insurance company paid out exactly what the policy dictated, but the policy itself was fatally insufficient for the real-world cost of building back. And the scale of this problem was so widespread that Colorado legislators passed new bills like HB 1174, mandating that the state publish an annual reconstruction cost report. They are acknowledging that this underinsurance problem is real and it's rampant. And this brings us to the specific traps built into modern policies. The reason homeowners get caught in this gap is that carriers are making subtle shifts in their policy language to mitigate their own massive losses, and these changes trip up anyone who tries to DIY their policy comparison.
Okay, so give me the big 3 technical changes that I'm not going to spot just by glancing at my renewal letter.
Trap number 1, the percentage deductible. This is the one we touched on that turns a minor claim into a massive out-of-pocket expense. Carriers have moved aggressively away from flat deductibles, the easy $1,000 or $2,500 that everybody knows, to percentage deductibles.
Specifically for wind and hail.
Specifically for wind and hail claims, often set between 1% and 5% of your total dwelling coverage.
Okay, let's break down that $10,000 math again, because that's the number that really needs to sink in.
Let's say your home's dwelling limit is $500,000. If your policy has a 2% wind and hail deductible, you are responsible for the first $10,000 in cash outlay for that specific claim.
$10,000.
So if a severe hailstorm hits and causes $15,000 in damage, the insurer only pays you $5,000. And here's the kicker. These deductibles are applied per claim, not per year.
Oh, wow.
So if you get hit by 2 separate severe events in 6 months, you could pay that $10,000 deductible twice. It's an immediate, massive financial hole. Trap number 2, the 10-year ACV rule. This is deadly for older homes, especially across the Front Range where so many roofs are aging. Many carriers now automatically shift coverage for older roof, say those 10 to 15 years old, from replacement cost value, RCV, to actual cash value, ACV.
Wait, so if I have an ACV policy, I'm essentially paying for all the years my roof sat in the sun. Is that
Yeah.
what depreciation means?
That is exactly right. RCV pays to replace the roof with new materials minus your regular deductible. ACV deducts depreciation first. So think of a 12-year-old roof with a replacement cost value of $10,000. If it has depreciated by 60%, an ACV policy might only pay out $4,000.
4,000.
Add in your $1,000 deductible, and you are left paying $7,000 out of pocket to replace a roof that insurance was supposed to cover. This is a deliberate strategy to keep carrier exposure low, and it shifts massive replacement costs back onto you, the homeowner. And trap number 3, and this truly is the hidden bankruptcy risk for anyone with an older home: ordinance or law coverage or code upgrades.
Okay.
If your 50-year-old home is destroyed by fire, you cannot rebuild it exactly as it was in 1975. You must rebuild it to current code think modern fire resistance, energy efficiency standards, accessibility requirements.
And if I didn't select or pay for sufficient code upgrade coverage?
You pay the difference out of pocket. Standard policies often have very low limits for this, sometimes just 10% of your dwelling coverage if they even include it at all. And while new Colorado legislation, starting in 2025, requires agents to offer at least 20% coverage, you still have to select and pay for it. Imagine your 50-year-old house needs $120,000 in code upgrades, and you only have $50,000 in ordinance or law coverage.
Oh, man.
That $70,000 shortfall comes directly from your pocket. That is what transforms a disaster into personal financial ruin.
That sequence of technical changes, the percentage deductible, the ACV shift, the code upgrade gap, that proves why a quick online quote is so insufficient. You can't spot these failures just by looking at the cheapest price.
Precisely. And it brings us to the necessity of professional guidance in this hard market. If big national names are restricting zip codes, and I'm just getting quotes that look high everywhere, what is the right professional path? Why can't I just stick with the captive agent who wrote my original policy?
And what's the fundamental difference between those two approaches?
Because that captive agent, your State Farm agent, your Allstate agent, they're restricted. They work for one company, they have one product line, and that one company is tightening its underwriting in Colorado zip codes aggressively.
So they're stuck.
They're stuck. If their one company decides your fire score is too high or your roof is too old, their job is done. They can't help you. You need an independent broker. We are not tied to a single carrier. We have access to 40-plus carriers. We can shop different policy forms, like finding an HO5 policy, which often provides superior comprehensive coverage over a basic HO3, and we can compare how those 40 carriers structure their percentage deductibles.
So you're comparing the fine print, not just the premium.
We compete on value E and coverage integrity, not just chasing the lowest price.
So if my current carrier just non-renewed me, where does an independent broker even look?
That's the advantage. We can access complex markets like the excess and surplus market, which carries risk that standard carriers won't touch. Or, as a true last resort, we can navigate the new Colorado Fair Plan. But those are complex safety nets. They're expensive, limited to about $750,000, and often pay out ACV, meaning you are still significantly exposed. That's why our core philosophy right now is, I'd rather explain the cost of adequate coverage now than explain why you aren't covered after the fire.
That makes a lot of sense. So we've established the crisis, we've defined the specific financial holes that most homeowners have, but the documents themselves are still 50 pages of legal jargon. How does the average person stop guessing and actually verify they have the right coverage without becoming an insurance expert overnight?
We built a unique service specifically to solve that gaps problem, and it's built around transparency. Most agents, they just send you a confusing multi-page PDF with a quote that you can't decipher. That doesn't really help anyone.
No.
What we offer is a custom video policy review. You send us your current declarations page, just the summary page, and then a human walks you through your policy line by line on a 5-minute screen-recorded video. We highlight the specific non-negotiable gaps you have.
So instead of me just reading a generic comparison sheet, I hear a person say, right here, this is your 2% percentage deductible, which means $10,000 out of pocket.
Exactly. We point out, here's the ACV trigger on your roof, and this is the insufficient limit on your code upgrade coverage. We show you the specific exposure using your own documents, and then we show you quotes from multiple carriers that are structured specifically to close those gaps.
It takes the guesswork out of liability.
It does.
That sounds incredibly useful for someone feeling overwhelmed by all the policy jargon and just unsure who to trust. So how do they get this custom video review?
Look, you can continue to try to decipher these 50-page contracts yourself, or you can let an independent broker do the necessary due diligence for you.
And it's free to get this custom review.
100%. There's no obligation. It's simple. Click the link in the description right now. Upload your current declarations page, we'll shop 40 carriers, find the gaps in your existing policy, and send you a 5-minute video breakdown of exactly what you should do to minimize your risk.
That's it.
Click the link, get the quote. Sleep better knowing you aren't gambling your financial future on a hidden deductible. And here's a final provocative thought for you to consider. The danger of doing nothing is proven by the success stories of mitigation. In Lyons, Colorado, a couple, Nick Schneider and Erica Ellingson, were non-renewed by their insurer because of their high wildfire risk.
Okay.
That harsh non-renewal letter was the kick in the pants that forced them to take immediate action. They spent time and money mitigating their property, clearing defensible space, and hardening their deck. Just a few months later, the Stone Canyon fire ripped right through their neighborhood, taking 5 homes nearby. Their mitigated home was saved.
Wow.
As Erica stated afterward, "For certain, our house would have been lost in that fire." You need to know your exposure now because the policy review is the first mandatory step that forces you to act before the next storm or the next fire.